Hey there, and welcome. If you're looking at bringing your company into the Japanese market, this is exactly where you need to be. We're going to break down the fundamentals of Japan's corporate tax system so you'll know precisely what to expect.
All right, so here's our game plan. We'll kick things off with the core idea of Japan's self-assessment system. Then we'll get into how you actually calculate your taxable income, what taxes you'll be paying, the deadlines you absolutely can't miss, and the local expert you'll need on your team. And of course, we'll wrap it all up with a quick summary. Okay, first things first. Let's get our heads around the basic principle of how corporate tax works in Japan. And trust me, this is a really key difference you've got to grasp right from the start. So in many countries, the government does the math for you and just sends you a bill, right? Simple. Well, Japan flips that script for corporate tax. It's a self-assessment system, which means the ball is completely in your court. Your company is responsible for calculating its own tax bill, filing the official return, and making the payment. All right, so if you're the one calculating the tax, how exactly do you do that? Well, it's not as simple as just looking at the profit on your financial statements. Oh no, there's a little more to it than that. Let's break this down. Think of it as a three-step process. First, you start with your standard pre-tax accounting profit. But then comes the most important step, tax adjustments. See, Japanese tax law has its own set of rules. You'll need to add back certain expenses that aren't deductible and subtract some other items. It's only after you make these specific adjustments that you get to your official taxable income. That's the number that really matters. Okay, so you've got your magic number, your taxable income. What taxes do you actually pay on it? Well, it's a mix of taxes paid to both the national and the local governments.
You're essentially dealing with three main taxes. The big one is the national corporate tax. Then, at the local level, you've got two more. There's the corporate enterprise tax, which is also based on your income, and then there's the corporate resident tax, which is a little bit quirky. So let's zoom in on this corporate resident tax because it's a two-parter. Part one is variable, and it's calculated based on your national corporate tax bill. But part two is a fixed flat rate amount. This part is based on things like the size of your company's capital and how many employees you have on the payroll.
That fixed part probably gets you wondering, right? What happens if you're a startup or you just have a tough year and don't make any profit? Do you still have to pay tax?
And the answer is a big, resounding yes. This is a critical point that catches a lot of people by surprise. Even if your company reports a loss, zero profit, you are still required to pay that fixed per capita part of the resident tax. For a small company, that's a minimum of 70,000 yen a year, no matter what. So when you bundle all the income-based taxes together, the national tax, the local taxes, what's the bottom line? Well, you can expect your overall effective tax rate to land somewhere in the neighborhood of 30 to 34%. Of course, the exact rate can wiggle a little based on your company's size and location.
Okay, so now you know what you'll be paying. Let's talk about when you have to pay it. And believe me, sticking to these deadlines is absolutely critical. First, a quick note on timing. You actually have the freedom to choose any 12-month period for your company's fiscal year. But here's a bit of an insider tip. A huge number of companies, especially the big ones, choose to end their fiscal year on March 31st. Why? Because it aligns perfectly with the government's own fiscal calendar, and that can make things a lot smoother. But no matter when your fiscal year ends, the rule for filing is simple and it is rock solid. You have exactly 2 months from your fiscal year end date. In that 2-month window, you have to both file your tax return and pay the tax you owe. So for a March 31st year end, that means everything is due by May 31st. So let's think about this. We've got tax adjustments, different kinds of taxes, a tax you pay even with no profit, and super strict deadlines. It's a lot, right? So how can you possibly make sure you're doing it all correctly? Well, that brings us to the single most important piece of advice I can give you. You have to understand that in Japan, professional roles are very distinct. You've probably worked with CPAs, and in Japan, their main job is auditing, making sure financial statements are accurate. But for anything and everything related to tax, you need a different specialist. You need a zerishi. A zerishi is a nationally licensed tax expert, and their exclusive role is to prepare tax returns, file them, and give tax advice. So let me be crystal clear about this. For a foreign company operating in Japan, hiring a zerishi isn't just a good idea. It's not a nice to have. It is a practical necessity. They are the key to navigating these laws correctly and are an absolutely indispensable partner for your business.
Okay, we have covered a ton of ground, so let's quickly boil it all down to the key things you absolutely need to walk away with.
All right, here are your 5 key takeaways. 1, it's a self-assessment system, meaning the responsibility is on you. 2, your taxable income is not your accounting profit. Remember those adjustments. 3, you have to pay a fixed local tax even if you have a loss. 4, that 2-month deadline is firm. And finally, number 5, hire a rishi. It's essential.
So, with this framework in mind, the single most important next step for your company is pretty clear, isn't it? It's not just about knowing the rules, it's about finding the right local tax expert to help you navigate them and build a compliant, successful strategy here in Japan.